Hello, everyone. Thank you for joining us for our 2024 second quarter economic update. My name is Gray Pendleton from Pendleton Financial. Excited to have you here today. So with that, I'd like to get started. At our firm, Pendleton Financial, we partner with clients and believe an educated client is our best client. We're always going to try to help you with your finances. We believe that knowledge is power. Okay, one of our missions is to share any knowledge with clients and help them make more informed decisions. So thank you for joining us here today, and please share this information with anyone who you think may find it helpful. So let's get started. After a strong first quarter of 2024, equity markets, the stock markets, began the quarter with a rough start, largely attributed to the Federal Reserve's decision not to reduce interest rates. All right, the reason is we're still seeing some higher than desired inflation. Now there's some favorable data coming out, so that's looking positive. But as the quarter progressed, strong performances from companies tied to artificial intelligence and a more favorable outlook on inflation changed that perspective. So by the quarter's end, investors saw multiple all-time highs, and records were continually being set. The broad-based S&P 500 returned 4% for the second quarter and closed at 5460. The Dow Jones, which doesn't have as much tech influence, made new highs, but finished down about 1.7%. All right, so following the strongest first quarter since the pre-pandemic days of 2019, the equity markets continue to build on their positive momentum in the second quarter, and the S&P 500 is up over 14% for the year. The Dow is up just 4% year to date. So, it's an interesting mix there. And part of that reason is because a lot of the growth, if you see in the market, is due to a lot of these technology names. So there's a kind of an outsized influence that a lot of these tech companies are having. Starting the quarter, inflation was still a concern. The Federal Reserve closely monitors the CPI, or Consumer Price Index. It's a broad measure of goods and service costs. The good news is that inflation showed some signs of slowing down in April, May, and June. In May, CPI was 3.3%. Based on the June results, many economists feel that the Fed may have done enough to keep current inflation down from the challenging rates of the last few years. So we'll see how that goes. The Fed did not raise the federal funds rate in the second quarter. So for the seventh session in a row, they've kept the target rate in the range of 5.25% to 5.5%. The Fed meets 8 times a year, and for the second half of 2024, there are 4 more meetings left. Most analysts still project that we will see a rate reduction before the end of the year. The news of improved inflation numbers and the Fed's commitment to cut interest rates in 2024 helped bond markets in the second quarter. We still have an inverted yield curve, meaning shorter-term bonds yield more than higher-term bonds, than longer-term bonds. As of the end of the quarter, the end of June, 5-year Treasury notes yielded 4.36%. 10 years were about 4.3 as well, and 20 years were at 4.6. 30 years, 4.5. So, still seeing some inversion there. This inverted yield curve has been long running, beginning in July 2022, nearly 7 consecutive quarters. Now, economists typically see this as a warning sign for a potential recession or poor market performance, but we've yet to see this come to fruition. So, in economics, the rules don't always apply. So, it is an art. Right now, investors can receive some interest on fixed income holdings. So we continue to monitor closely how the Fed's movements and interest rates are affecting bond yields. With the Fed anticipating lower interest rates this year, the opportunity to lock into these higher yielding bonds may drop, and expect to see kind of the rates on short-term money go down whenever the Fed does lower rates. But again, a lot of folks were calling for rate decreases already this year, and we haven't had any. Safety does come with a cost, and even though interest rates have risen, many major banks are still offering low interest rates to savers. According to Barron's, the average bank money market rate on July 1st was only 0.56%, which is shocking. The average 12-month CD rate was 2%. So while these have increased in the last 12 months, many savers are still seeing lower returns. We have a lot of certainly much higher rates available and to our clients, and so if you're seeing rates between 1% to 2% or 3% or 4% or less, let us know. The global economy experienced continued uncertainty during the second quarter. Global tensions persisted, including conflicts in the Middle East and the ongoing war, Russia-Ukraine, where Russia has invaded Ukraine. Also, this is the presidential election year. This typically creates headlines. In addition, there are some key races for the Senate and House of Representatives. The outcomes of these elections could impact policy and tax law, leaving much uncertainty. While earnings and the economy are the main driver of financial markets, one of our roles is to keep a close watch about how these events may impact the equity markets. And as most of you know, Biden has just dropped out of the presidential race. He's still president of the United States, so we'll see how things shake out. Looks like Kamala Harris and Donald Trump will be running against each other in the upcoming election. We're currently experiencing a bull market, and the question is how long it can last. While the U.S. economy continues showing signs of strength and resilience, positive inflation numbers will be key to the Fed being confident enough to start cutting rates. Should the economy maintain a healthy status, we may see a soft landing. However, should the economy experience a slowdown, recession concerns could increase. Will we experience an overdue pullback? For the first half of 2024, investors have not seen any large pullbacks. But as a reminder, they're a part of the normal investment experience. We like to say, expect a 10 to 15% decline every year. We won't always get one, and expect a 30 to 50% decline in equity markets, roughly every 5 years. So 5 to 10 years, and there's no way to predict when that will happen. But speculation is not a good strategy. Just stay vigilant, focused on your well-deserved long-term personal goals. Make sure you have enough cash to maintain cash flow in the near term. All right, there's been a lot of talk of stagflation. It's emerging in the news. Stagflation is the name that for an economic cycle where we experience slow economic growth, a high unemployment rate, and increased inflation. This can be a precarious situation to fix for policymakers because you try to fix one factor and it aggravates another. For the record, Fed Chair Jerome Powell is confident that we are not in a state of stagflation, stating that he sees that neither the stag nor the deflation, that he didn't really understand where talk of stagflation scenario is coming from. And that was as of May, so don't think we're there. It's important to consider equity investments from a long-term perspective. It's a good time to review your investments and ensure they align with your goals. Vigilantly monitor everything involved in the decision-making process and your investment decisions. Now, that's what we do for our clients, but it's a good idea just to have a discussion about it. So we believe a proactive preparation in providing clients with a resilient financial strategy that is time-tested. All right, so as a recap here, here's where we are. Equity markets closed out the second quarter with solid results. The federal funds rates are just about 5 to 5.5%. We do have that inverted yield curve, mainly because the short-term rates are so high relative to the longer rates. No longer anticipating 3 rate cuts this year. Everything's looking fairly good. There's a lot of volatility. There's a lot of uncertainty in the news. It's been just a wild year so far, so hopefully things smooth out a little bit and stay the course, focus on the long run. So yeah, we certainly appreciate you. We have a couple of events coming up, one in September 15th at the Durham Bulls Athletic Park and another November 15th, so look forward to having you there. And yeah, thanks for joining us today, and feel free to reach out if you have any questions. Look forward to talking with you soon. Take care.